Hello all and welcome to today's video. So the topic of today's discussion is again on the Adani group of stocks. So we are seeing a lot of volatility in the past few weeks in these stocks. It has almost recovered and reached the 2000 levels, but again because of some bad news it has fallen back to 1500 levels or 1600 levels. So for those retail investors who are still kind of stuck in this stock, I would urge them to use this recovery opportunity to exit from this stock. Although there were two positive signs in this stock, that the bond prices were kind of very stable of Adani groups, and also that the recovery was seen, a sharp rise was seen from the 200-day exponential moving average, and that's why a recovery was expected. And with every recovery you should have exited your position. Again, for those retail investors who are still have their position, open position in Adani group of stocks, I would say that use this recovery opportunity to exit from this stock. Expect a loss of almost 8 to 10%. That will be a good bet instead of waiting for to even out your position or to gain profit from this situation. So that will be an ideal strategy. Exit in a step-by-step manner. The topic of today's discussion is not on the exit strategy from the Adani stocks. It was mainly an exercise that I wanted to do with the viewers to see if we could have spotted this accounting malfunction or should have avoided our investment in Adani group of stocks based on the metrics and based on the numbers that I looked on screener. Now generally screening of stocks is a very time consuming step and does require a lot of knowledge of the terminologies used in the accounting practices, and hence a lot of new investors, retail investors sort of avoid this step or overlook this step. With all the data that is available at one place in screener, it has become very less time consuming and very straightforward to do your screening of stocks. I think it hardly takes 15 minutes of your time to go through these fundamentals of the stock, and that will generally help you to decide, choose your investments wisely. So with that said, let's get started on our exercise. So firstly, I'll compare Adani Enterprises stock with the Pidilite stock with the same set of metrics. Again, Pidilite has been over the years very consistent in the way it attracts its shareholders, has been consistently giving dividend, has been a good company with a lot of less negative noise about it. So that's why I'm choosing Pidilite as a company which is like a strong fundamental company. And against that we'll compare the Adani Enterprises stock, which have given a sharp rise within this short span. Like within 3 years it has shown a very high trading volume and a high growth in the stock. So we'll just compare them side by side and see how their numbers look like, and how we should have avoided the Adani group of stocks just by looking at these metrics that we have defined on screener. So let's get started. So first we'll just glance through the Adani Enterprises screener website. So we can see here there are certain cons that are mentioned on this site. The first is the company has low interest coverage ratio, which means that the company is not paying the interest on the debt that it has borrowed in a timely manner. And we know that Adani has a lot of debt under it, but it's not paying the interest on time. So this is really bad news. And also the second point is the dividend payout ratio has been very low, which means that the group of companies not also paying its shareholders its fair share of dividends. Is not even taking care of its shareholders. So how it is taking care of India, that was a very bad point and bad response to that Hindenburg report, which was put out by Adani, that it was a direct attack on India. So first, take care of your shareholders, pay your debt on time, then only you can give that response that it was a direct attack on India. And if we come down to the profit and loss statement, let's see over the years how the company has performed. So we can see that there has been a sales growth and operating profit growth has been quite stable over the last 10 years. See, you can see that it has been quite stable. Actually, it has seen a drop in the operating profit. So a question of like how the stock price was rising, that is again very doubtful. Even though the profits are not increasing, the margins have compressed a lot from 15-13% to 5%, which is again a very bad sign. Now see here the other income section. If you see, there has been a sharp rise in the miscellaneous income. because this income has to be very low, like there will be certain miscellaneous income, but that should not be such on a higher scale as compared to your see the tax. Let's see the tax person. You can clearly see that there has been pretty much inconsistency in which the income tax has been rolled out. Normally corporates roll out income tax at around 30%. So again this raises eyebrows. If you see, the EPS has been compressed, the dividend payout has been low. So there is the story basically does not add up, like why the stock price was on such a good momentum in the last 3 years, even though the profits are lowering, the margins are compressing, the EPS has been slowing down. So how come the stock prices are rising? Now if you come to the balance sheet, I think the one number that we should look at in the balance sheet is the capital work in progress, because there is a lot of scope. If the capital work in progress is very high, that means there is something very fraud happening with the company, because they are not disclosing their capital and saying that it is the work is in progress. Now there is a very high chance of accounting malpractices if your capital work in progress is very high. And if you come down, look at the shareholding patterns, you can see that FIS has been consistently selling, decreasing their position in this particular stocks. So that is again a very bad news. So in general, when the FPIs or the foreign investors generally prefer clean companies, clean management. Now if you come back to the metrics that we have defined, so these are some of the metrics that are directly available, some of the metrics that you can easily create using the formulas that I have used. I link that link in the description. Using that you can quickly add up this in your setup and have this setup while screening your stocks almost every time. So like we have seen in cons also that the dividend yield has been very low. This is on the lower side. ROC ROE ratios has been very low. This for a healthy good companies it's around 20%. So these numbers are also very low. Operating cash from EBITDA, this number has to be within the range of lower than once. What this means is that if you look at your operating cash, and if you look at the earnings before income tax and depreciation and all, most of your companies cash should come from your business earnings. But what this number is telling us, that there is an extra source of cash of which the source is unknown and it is not coming from the business earnings. So this ratio has to be lower than, on a slightly lower side of 1, but we see that this ratio is almost in the range of above 1. So which raises a serious question about where this extra source of cash is coming from. The next ratio, CFO by PAT, which is again cash from the operating margin, operating activities divided by profit after tax. So this is also on a very high level, which means that again it is telling some extra source of cash is there, which is not coming from the company's profit. Now this ratio is very important to check on the cash theft check, whether the company has some accounting fraud going on. So this ratio, if you look at a good fundamental company, this ratio is always below 0.1 0.15. Having this ratio above 0.3 generally is a very bad sign. There is a lot of contingent liabilities of the companies. And also this particular value, cash working capital work in progress, also denotes something bad going on with the accounting practices. This ratio also needs, if you check for any good fundamental companies, is also lower than 0.1. So here you can see a very high value of capital work in progress. So again a very bad sign. If you look at the free cash flow by sales ratio, it means that the growing sales or the increase in sales is not reflecting in the free cash flow of the company. So again a very bad sign. I by E value is basically whatever the company is earning, it should put back a certain amount in the growth of the company. A larger portion of the money is invested back. So there is, you can see here, this is very fishy, that the company is putting back a larger chunk of money as opposed to its earning. So it is earning, let's say 100 rupees, it is putting back 227 rupees in the growth of the company. So again, this also points out to an extra unknown source of cash that we already have talked about. Altman Z score is directly available. This ratio has to be around 4. This ratio, if it is around 3 or 4, that means that something is bad with the accounting practices. Again, debt to equity is very high debt. We can see the cash producing ability of the company is in negative. So generally it's not producing cash also, but there is an unknown source of cash through which it is running its business. So this all metrics, even if even if one or two metrics are on the negative side, that we can still consider for investments, but almost every metric is pointing towards extra unknown source of cash that is not able to these metrics are not able to identify. So we have looked at this matrices. We have looked at the profit and loss statements overview within this 10 minutes, and it tells a different story that the numbers don't match up. There is an unknown source of cash, and generally such companies, when you take for investment, you can disregard this company for investment perspective just by looking at these numbers. So now let's look at the numbers of Pidilite. So again, we'll just glance through first the numbers. There is no con, that is very much a positive sign. Then again, if you look at the profit and loss statements, you can see the sales has been consistently growing, profits has been consistently growing, margins has been pretty stable around 17-19%. The tax payout is also very consistent. We can see how consistently, in a consistent manner, the tax has been paid out. There has been a very good growth in EPS, and that is reflected in the stock price as well. Dividend payout has been very much healthy. So this is a sign of a good company. The story of on the paper is reflected in the stock price as well, and that's how safe investments are made. So there won't be any possibility, almost 90% chances that your investment is safe if you choose if you would have chosen Pidilite over Adani stock. Again, if you look at the other income, see the proportion of other income here and see the proportion of other income in Adani stock. So these are the signs of good corporate governance, good corporate management. If you look at the cash from operating activities, the cash has been growing. Again, if you look at the FIS investments, now FIS investments have been pretty much stable around 11%. If you look at the metrics that I had defined at the start, dividend yield, and compare this number to Adani's number, you will soon realize how stark difference there is in these two companies. So dividend yield is very good. ROC, ROE ratios, again, as I mentioned, this to be around 20% for a good company, for good investment company. If you look at OC from EBITDA is below 1, around 0.7. CFO by PAT is again below 1, around 1 range, which is very good. Contingent liabilities is very low, and capital work in progress is also very low. So again, both these values are below 0.1, which is again a very good sign. Sales, free cash flow is generated from its sales, so you can see a cash generating ability of the company. We see that I by E ratio is almost 50%, which means out of the earnings, it is putting 50% back in the growth of the company. So almost a very good sign. See the Altman Z score is around 22, and see the Altman Z score of Adani stocks. That ratio itself will tell you that you should have avoided your investment in this stock. The cash generating ability is very good. The free cash flow growth is there. Capital operating cash from operating activities growth is there. Pledge percentage is 0. Debt is very much on a lower side. So these are the sign of a good company. What else you need to look at? Within 15 minutes we could have gone through this set of numbers and made our investment decision. Again, we could have looked in technical side of details as well, but as a layman, as a new investors who is just entering in the market, these numbers are good enough to choose your investments. So that's it from this video. I hope there was a lot of learning for the retail investors from this video, and in case if you feel like any metric or any ratios that will be again useful for the setup of this for identifying such accounting malpractices, do put them in the comment section. we will discuss it and add in the setup and make the setup more richer to identify such fraud companies for the retail investors. For the next setup investments that you guys do use this setup, and let me know how you feel about it. So if you like the content, please subscribe to the channel and share it among the other retail investors also, so that it will be helpful for them as well. Thank you for watching this video. Take care. Goodbye.